Do you sometimes feel like the world of investing is a bit like trying to solve a Rubik's Cube blindfolded? You know all the pieces are there, but figuring out how to put them all together can be a real head scratcher. But what if I told you there's a way to invest that simpler, potentially less risky, and doesn't require you to become the next Warren Buffett overnight? Enter ETFs or exchange traded funds. Think of them as the ready meals of the investing world. They're pre-packaged, convenient, and can offer an immediate starter for your portfolio without you having to become a master chef. Let's dive in. So, what exactly is an ETF? Well, in simple terms, an ETF is a type of investment fund that trades on the stock exchange just like individual stocks. But instead of buying shares in a single company when you're buying an ETF, you're buying a slice of a whole basket of different investments. Imagine you're at a pick and mix counter. Okay, so bear with me here, I promise this analogy works. Instead of carefully selecting each sweet individually, an ETF is like buying a pre-mixed bag that gives you a bit of everything. You get exposure to a wide range of sweets, or in this case, investments, in one go, which is really cool. Now, why should you care about ETFs? Well, they offer several potential benefits that make them attractive to both beginner and experienced investors alike. Diversification. Remember that old saying about not putting all your eggs in one basket? Well, ETFs are like having multiple baskets, each filled with different types of eggs. By spreading your investments across many different securities, you're potentially reducing your risk. Many ETFs have lower fees compared to actively managed mutual funds. It's like buying in bulk at the supermarket, where you often get more for your money. ETFs trade on exchanges just like stocks, so you can buy and sell them throughout the trading day. It's as easy as online shopping, though perhaps not quite as addictive. Transparency. Most ETFs disclose their holdings daily, so you always know what you own. In this way, it's like having a clear shopping bag. You can see exactly what you've bought. Okay, so let's dive a bit deeper into how ETFs work. At their core, most ETFs are designed to track an index. So, an index in the financial world is like a shopping list of investments that represent a particular market or sector. For example, the FTSE 100 index is a list of the 100 largest companies listed on the London Stock Exchange. An ETF that tracks the FTSE 100 would aim to replicate the performance of these 100 companies. But here's where it gets interesting. ETFs aren't limited to just stock market indices. There are ETFs that track bonds, commodities, currencies, and even more exotic investments like cryptocurrency. It's like having access to a global supermarket of investments, all from the comfort of your laptop or smartphone. Now, let's get into some of these different types of ETFs. Market ETFs. Now, these track a specific index like the FTSE 100 or S&P 500. They're like the vanilla ice cream of the ETF world, a classic choice that forms the foundation of many portfolios. Sector ETFs. These focus on a specific industry like technology or healthcare. They're a bit like choosing a specific aisle in the supermarket. You're zeroing in on a particular area you think might perform well. Bond ETFs. These invest in various types of bonds. Think of them as the comfort food of your investment portfolio. Generally less volatile than stocks, but still with the potential for steady returns. Commodity ETFs. These track the price of commodities like gold, oil, or even agricultural products. They're like adding some exotic spice to your investment mix. Now, here's where it gets really interesting from an economic perspective. ETFs use a mechanism called creation and redemption to keep their market price close to the value of their underlying assets. Now, this process involves large institutional investors and helps ensure that ETFs trade at a fair price. It's a great example of how financial markets can self-correct and maintain efficiency. Now, you might be wondering, okay, this all sounds great, but how do I actually start investing in ETFs? Great question. Here's a step-by-step guide. Step 1, determine your investment goals. Are you saving for retirement, a house down payment, your child's education. Whatever it is, your goals will influence which ETFs might be right for you. Step 2, assess your risk tolerance. How comfortable are you with the possibility of losing money in the short term? This will help you decide between more conservative or more aggressive ETFs. Step 3, research different ETFs. Look at things like the index that they track, their expense ratio, so that's the annual fee, and their historical performance. In the UK, you might consider ETFs that track indices like the FTSE 100, the FTSE All Share, or even global indices. Step 4, open a brokerage account. So you'll need this to buy ETFs. Now, many online brokers in the UK offer commission-free ETF trades. Consider opening a stocks and shares ISA to take advantage of the tax benefits. Step 5, start small. You don't need a lot of money to start, so many brokers allow you to buy fractional shares of ETFs, meaning you can start investing with as little as £5 or £10. Step 6, set up regular investments. Consider setting up automatic monthly investments. This strategy, known as pound cost averaging, can help smooth out the ups and downs of the market over time. Speaking from personal experience, my husband and I made a concerted effort to invest in ETFs, particularly when our girls were born. Time was just flying and we wanted to take full advantage of compound interest. So that's the snowball effect, where you earn returns on your returns over time. Because we don't plan to touch our ETF investments anytime soon, we opted for a riskier portfolio with fewer bond shares. Though we'll likely reevaluate our risk appetite as time goes on and as we get closer to potentially drawing on some of the investment for our girls' future. Now, this brings me to an important point. Your investment strategy should evolve as your life circumstances change. What's right for you in your 20s might not be right for you in your 40s or 60s. Just as a quick aside, if you're finding this video useful, please feel free to give it a thumbs up and subscribe for more bite-sized economics and investing insights. Now, let me put on my Economist hat on for a moment and consider how ETFs fit into the broader economic landscape. ETFs have become increasingly popular over the past couple of decades, and they've had some interesting effects on the financial markets. Before ETFs, it was actually quite difficult and expensive for individual investors to achieve the kind of diversification that institutional investors could. ETFs have leveled the playing field, giving everyday investors like you and me access to a wide range of markets and asset classes. ETFs have also increased market efficiency. Because they trade throughout the day and are often used by large institutional investors, they can help to quickly incorporate new information into asset prices. This aligns with the efficient market hypothesis we talked about in our bull and bear markets video, and I'll put a link to that video in the description below. The idea that asset prices reflect all available information. So, how might you use ETFs in your own investment strategy? Here are a few ideas. Core satellite approach. Use broad market ETFs as the core of your portfolio, and then add individual stocks or specialised ETFs as satellites for specific opportunities or themes that you believe in. Asset allocation. Use different ETFs to easily adjust your mix of stocks, bonds, and other asset classes based on your risk tolerance and investment goals. Geographic diversification. Invest in ETFs tracking markets in different countries or regions to spread your risk globally. Thematic investing. Use sector or thematic ETFs to invest in trends you believe will shape the future, like renewable energy or artificial intelligence. Income generation. So some ETFs focus on dividend-paying stocks or bonds, which can be useful if you're looking for regular income from your investments. Finally, let's address a common question that people ask, which is, should I use ETFs or pick individual stocks? Well, my answer is usually this. Why not both? ETFs can form a solid foundation for your portfolio, giving you broad market exposure at a low cost. And then if you enjoy researching companies and are comfortable with the additional risk, you could allocate a portion of your portfolio to individual stocks. It's a bit like cooking. ETFs are your reliable everyday meals that keep you healthy and satisfied, while individual stocks are like those special dishes you make when you want to flex your culinary muscles. Both have their place in a balanced diet, or in this case, a balanced portfolio. I hope this video has helped decode ETFs for you. And hey, let me know in the comments whether you've used ETFs in your investing. And if not, do you think you might give them a go? Thanks for watching, and I'll see you in the next video.